US stocks are broadly unchanged across the week, and the US dollar has staged a modest recovery after recent data and comments from Powell have raised some questions over how aggressively the Fed will be cutting rates going forward. But what should we be watching this week? To talk us through the week ahead, I'm joined by Global Head of Content, John Kicklighter. Thank you for joining us, John.
Thanks for having me.
So, John, we've seen a little bit more volatility this past week, and stocks are set to end September, a typically weak month, on the front foot. Talk us through the general market conditions we can be expecting next week and which markets you're going to be watching.
So it's quite interesting that, to what you mentioned, September is usually one of the weakest months of the year for the S&P 500. Obviously, this is the 39th week that we're just closing out, and it is historically the weakest month of the calendar year. Of course, past performance not indicative of future returns, but it really does deviate from those norms, and that's been a consistency that we've seen through this month and even in periods before. So it's a persistent crawl of a risk on. I know I've said this multiple times before, but it's risk on, but it doesn't have a whole lot of heart, and there's not a lot of strong drive there. A little bit of a pullback, but not, I think, inflammatory enough. The markets are not overstretched or concerned enough that even I think it was only the second 3-day loss for the NASDAQ 100 this past week through Thursday that we had seen in 6 months. And that's not enough to just trip off a risk-off environment. The markets are still willing to stick to that crawl higher. And we have to see when the markets are going to be willing enough or sentiment-driven enough that they're going to be either pursued towards greed, like a significant uptake in risk on and not just a crawl, or a substantial move towards risk aversion. But we are starting to see a little bit of traction in some of the themes. But for the market side, I'd really be watching into this coming week. I stick with the ones that I was watching this past week: NASDAQ 100, the dollar for sure, gold. But then also I'd add to that mix the U.S. 2-year Treasury yield, because it does have a more definitive reflection of interest rate expectations in the United States.
And then what about themes? What are the most patent themes that could upend the calm?
So those markets are chosen specifically because of the themes, and I think they're going to be little warning signals if there is traction to be found, and it will start with those markets and probably cascade into particularly a risk on, risk off, or through one of these significant themes. The first theme is just the general state of risk. Is it risk for risk's sake? Are we just crawling up, or do we actually have that connection to risk appetite? Is it driven by something like AI or exaggerated expectations of growth potential or something like that, or the relief of a burden like tariffs? I don't see a lot of it. I do see connection to the AI and a lot of justification after the fact, but there's not necessarily a broad performance that comes of just the AI trade. So it seems like it's risk for risk's sake. So I would watch these risk-oriented assets, both the risk-on type, like equity indices or emerging market assets, high-yield fixed income, and crypto, and then look at the safe havens as well, because they're the opposite end of the spectrum, like gold and dollar and other treasury assets. So risk is one. A little bit more specific, I'd be watching the U.S. government shutdown story. Maybe it's resolved over the weekend. I don't know. But as we go into the close of this week, it is not looking positive. And the U.S. is due to run out of money come, I believe, the end of Tuesday, so rolling into October. And this, I mean, we've seen some government shutdowns before, and they slowly add to the credit quality, the sovereign credit ratings of the U.S., and that's why we don't have a AAA rating across all the 3 major rating agencies. But I think it's a little bit more intensive this time, because the president has suggested that if there is a shutdown, it's not just furloughs, it is actually layoffs. So that's a significant loss of jobs, which again tips the scales on things like monetary policy and growth potential, and certainly does call into question some other factors of the U.S. trade. And a third consideration that's been kind of exaggerated because of the PCE deflator ticked up as expected, highest reading on the headline figure 2.7, just over 2.7%, that we had seen since April 2024, it's going to feed into the questions of how fast will the Fed actually ease its monetary policy. We talked about that last week too. Now it's getting a little bit more complicated, and it's going to really be exacerbated, especially if there is some conundrum that we get from the high profile event risk that we have next week, including Friday's non-farm payrolls.
So yes, let's talk about those events next week. Which events will you be watching, and which may prove to be catalysts for those themes?
So there is a lot of event risk, but it's concentrated on specific days. Monday, I mean, I would set aside Mexican unemployment rate and eurozone confidence figures. Those are not very market moving. So Monday, you're probably not going to see a major theme. Maybe some regional volatility, of course, with those event risks, but nothing systemic unless it's coming out of the headlines. So I wouldn't rely on event risk there. Tuesday, things kick in a lot, actually. We have in the Asia session the Chinese PMIs. So we're going to get an insight into economic activity in the second largest economy in the world. That's very important. We also have the RBA rate decision in the APAC session. And then in the U.S., we're going to get U.S. consumer confidence from the Conference Board, the JOLTS figures, which are both quits and hires. So those are going to be very informative aggregates in advance of the non-farm payrolls later in the week. And then, of course, we have the government shutdown. Will it happen or will it not happen? That's going to be very important. It's going to have a lot of people holding their breath. So Monday is going to be a breath-holding exercise. If we don't have the government shutdown resolved, the continuing resolution resolved in advance over the weekend or Monday. Wednesday, we get into some business confidence figures for Japan. We have the eurozone inflation figures, Mexican business confidence. So a lot of trade consideration, monetary policy in the eurozone. I would watch the U.S. ISM manufacturing report because that does tell us how U.S. jobs are doing. And obviously, manufacturing is supposed to be a benefactor of some of these tariffs. And we want to see how that is actually playing out. It's not the largest growth component in the United States, but it is important economically to the tariff narrative. So that's one to watch. And you also have Canada manufacturing. Again, the trade relationships are going to be stirred up a little bit there. Thursday, not a lot that I would highlight. Again, it's going to be a Thursday event anticipation into Friday, because Friday carries the major events, and that includes non-farm payrolls, which is going to be very important. Now, a couple of scenario considerations. If the non-farm payrolls figure is strong, paired with the PCE deflator that we had today, this Friday, it's going to argue for a slower path of rate cuts, maybe not, obviously, skip the next one, and maybe not even get a second rate cut in 2025. That I don't think is priced into the markets, and that would lead to some significant deviations. You'll see that into your yields in the dollar. Alternatively, if we have inflation picking up and non-farm payrolls, let's say, goes negative again, then we have a much more complicated situation for monetary policy. Obviously, the pressure is going to intensify on the Fed from the White House and from others, and it's going to really lead the markets to a greater amount of speculation and lack of clarity. And that pressure could add to more volatility going forward until we actually get that monetary policy view resolved.
Well, thank you once again for your analysis, John.
Thank you.
For more videos like this, please do like and subscribe.